If you've been looking at UK dividend stocks, trying to work out which ones are worth owning, this video should save you a lot of time. Because today I'm ranking 12 of the most popular dividend paying companies in the UK. I'll be using my 10 years of experience working as an analyst in asset management to rate them on 6 key areas: revenue growth, profitability and free cash flow, valuation, risk, dividend yield and sustainability, and the current macro environment. I'm going to do it from the perspective of your average investor that wants a long-term hold of a reliable and sustainable dividend payer. It's all, of course, just my personal opinion. With that, let's get into it. Let's start with the one I get asked about the most. BP yields 4.61% and they've committed to raising their dividend by at least 4% a year. But there's 2 things that hold it back. The first is debt. BP owes $38 billion more than it holds in cash, and it's been increasing. It's got serious enough that in February they stopped buying back their own shares, which they've been doing for years, and put that money towards the debt instead. The second is oil. The price at the time of this video is around $100, but by the time you watch this, it could be 20% either side of that. And that's the issue. It's so volatile due to the conflict in the Middle East. When the price is high, BP earns more, but they've also warned they'll be pumping less oil because of the disruption out there. You'll also see the payout ratio is at 158%, which measures how well covered the dividend is by earnings. But don't read too much into that for BP, because last year they had to write down the value of some of its assets, which reduced its profit on paper. So the dividend itself looks safe enough for now, but there's no buyback left to cut if things get worse, which then puts the dividend next in line. So for those reasons, BP goes into C tier. The pharmaceutical giant GSK has plenty going for it. The dividend yield is 3.77%. It's increased the dividend by about 8% over the past year, and it's now gone up 3 years running, plus a healthy payout ratio at 45%. But it's a business I'd call steady rather than spectacular. Sales have grown 3 to 4% a year for the last 3 years, and they keep nearly 30 pence of profit out of every pound they sell. You're also not paying much for it. The price to earnings ratio, which is the share price divided by the earnings per share, is currently around 13. By comparison, AstraZeneca sits on 25. There's 2 risks worth knowing about though. The first is the pipeline, which is a risk with any drug company. Patents run out, and if the next drug isn't ready, the revenue goes with it. GSK put 6.6 billion a year into research, over 1/5 of everything it sells, so they're certainly spending to stay in the game. The second is the USA, where most of its profits come from, and where there's been a big push to get drug companies to lower their prices. GSK agreed to do that back in December, in return for avoiding US tariffs until 2029, but it's still being phased in, so it's not yet clear what the impact will be, just something to keep an eye on. All that considered though, for me, GSK is comfortably A tier. Tesco is the biggest supermarket in the country with about 28% of the UK grocery market, roughly double Sainsbury's. The dividend yields 3.04% and it went up nearly 6% last year, off the back of sales growing over 5%. The payout ratio is 52%, so it's well covered, and that compares to Sainsbury's at 80%. It isn't expensive either, with a PE ratio of 18, compared to nearly 20 for Sainsbury's and over 30 for Marks & Spencer. The biggest headwind for Tesco is its margins. On every pound that goes through the till, Tesco makes about 4p in operating profit, and that drops to 2p once all its other costs are paid. That hasn't moved in 3 years, even with sales growing. Like a lot of UK businesses, they've had huge increases in taxes, wages and energy costs, with increasing pressure from consumers to keep prices down. Then there's Aldi and Lidl, who now take close to 1/5 of the market between them, and that competition will only get stronger. Having said that, it's still a solid business and the dividend is safe. So for me, Tesco goes into B tier. WPP is an advertising group. They make the ads and buy the space for big brands, so what they earn depends on how much companies spend on marketing. It yields 5.43%, which looks amazing until you know where it came from. WPP is actually more than halved its dividend. The only reason the yield is that high is the share price has collapsed, down about 36% in a year and close to a 16-year low. Sales fell 8%, and they made a loss. There is a case for it. There's a new chief executive who is a 2-year plan to turn it around. And the shares are cheap enough that if it works, there's a lot of room. But this is a video about reliable dividends, and this one has already been cut in half. So I'm putting WPP in D tier. Cranswick is a major food producer and supplier. They've raised their dividend every single year for 36 years, through the financial crisis, through COVID, through everything since. Last year, it went up over 11%. The payout ratio is 35%, so barely 1/3 of what it earns goes out as dividends. Sales grew nearly 10% last year, profits were up 18%, and the margin has improved 3 years running, from 6.4 pence in the pound to 7.8. There's also barely any debt. The only downside, depending on how you look at it, is the yield is only 2.05%. That's really a reflection of how well the shares have done. They're up more than 60% over 3 years and sitting only a few percent below all-time highs. The dividend has kept climbing, but the share price has climbed faster, and that pushes the yield down. It also means it isn't the cheapest stock going, with a PE of 19, although that's roughly where a lot of the food sector trades. None of which is a reason to avoid it. It just means you're buying this one for a dividend that grows over time, rather than for the income it pays you today. So for those reasons, Cranswick goes into A tier. Imperial Brands is one of the biggest tobacco companies in the world, and it pays one of the better yields you'll find at 5.72%. They did cut the dividend by a third back in 2020 to pay down debt, but it's gone up every year since, and the payout ratio is 74%. They've been buying back a lot of their own shares as well, which has helped support the share price. It isn't expensive either, with a PE of 13 that drops to 8 on a forward PE basis. That looks at what it's expected to earn next year. You will see dividend growth show as a negative number, but that's only because they've moved from 2 big payments and 2 small ones a year to 4 equal ones. The annual total has actually gone up slightly. My main worry with this one is the industry. Cigarette volumes are falling 3 to 4% a year, and that isn't going to turn around. So a lot rides on how well they can move into things like vaping and nicotine pouches. That side is growing at nearly 14% a year, which is promising, but it still only makes up about 5% of what they sell. So a good yield, plenty of buybacks, and a decent record since 2020. I'm just not confident enough about where this industry ends up in 10 years. So for me, Imperial goes into C tier. If you want to discuss any of these companies we're talking about today, I run an investing community called Zero to Investor, where we talk about exactly this type of thing. It's linked in the description below. Lloyds is the biggest mortgage lender in the country, and it's had a very good year. The shares are up 46%, and sitting just short of their high. Profits were up 5%, earnings per share up 11%, the dividend went up 15%, and they're partway through buying back up to £1.75 billion of their own shares. That share price run is also why the yield looks modest at 3.25%. The dividend has been rising, the share price has just been rising faster. But despite all that, there's a fair bit sitting against it. The main one is the car finance redress scheme, after the regulator found that customers weren't being told about commissions being paid to dealers. Lloyds is the biggest car finance lender in the UK and has set aside nearly £2 billion to compensate people, which is around 40% of everything the bank earned last year. Barclays, for comparison, set aside about 325 million. They've already put that money aside, so it won't be a shock. The risk is that it turns out to be more, and the courts won't hear potential challenges until December at the earliest. So it's a bank that's doing well at a price that reflects it. It's just got that compensation hanging over it. So for that, I put Lloyds into B tier. Now, NatWest. Every couple of years, the Bank of England runs a stress test on banks, modelling a severe recession to see who would come through it. In the last one, published back in December, NatWest lost less capital than any other UK bank and didn't have to take any action to get there. It's also holding more capital than the regulator asks it to. Profits were up 21% last year and earnings per share up 27%, helped along by the fact they've been buying back their own shares. And there's another £750 million buyback running at the moment. Back in May, they nudged their income guidance for this year up to the top end of their range, so around £17.6 billion. The dividend yields 4.75%, and it's the cheapest of the big banks on a PE of 10, against 12 for Barclays and 15 for Lloyds. Comparing NatWest to Lloyds, NatWest is cheaper, it pays you more, it's better capitalised, and it doesn't have a £2 billion redress bill hanging over it. One risk might be that it's a UK-only bank, so you could say it isn't as diversified as some of its competitors, but it's the one here where I struggle to find much wrong. So NatWest takes the top spot and it goes into S tier. National Grid runs the electricity and gas networks here in the UK and in parts of northeastern United States. Regulators set how much it's allowed to charge customers, and National Grid earns a return on the money it puts into the network. Their policy is to grow their dividend in line with inflation. Last year it went up 3.8%, it yields 3.93%, and a payout ratio of 50%. It isn't expensive either, with a PE of 19, where other regulated utilities like SSE and Severn Trent up around 23 to 24. The problem is what it costs to run the network. National Grid is spending more on building and maintaining it than the business actually brings in. And last year that gap was over £2 billion. That money has to be borrowed. They already own nearly £45 billion, which is more than double what the whole business turns over in a year. And that debt is getting more expensive. A lot of it was taken on when rates were far lower than they are now. And as it comes up for renewal, it's been financed at today's rates instead. And that's why for me, National Grid goes into C tier. BAE Systems makes fighter jets, submarines and weapon systems, mostly for governments. Its order book is what stands out. They've got £83 billion of work already signed and waiting to be delivered, against sales of about £28 billion last year. So that's roughly 3 years of work already banked before they win anything new. And defence budgets across Europe are only going to continue to increase. The dividend yields a low 1.89%, even with it going up 10% last year. The payout ratio is 50%, and there's very little debt on the balance sheet. Where it gets harder to justify is the price. BAE is on a PE of 29, where Rolls-Royce is 20 and Kinetic is 24, which means you're paying a premium for a fairly small income. But the quality of the business is hard to argue with, so BAE goes into A tier. Reckitt is a multinational consumer goods company. The dividend yields 4.3% and the payout ratio is 44%, so it's well covered. It went up 5% last year, and shareholders also got a one-off special payment after Reckitt sold its essential home business. It's relatively cheap as well, with a PE of 10 compared to Unilever on 20. But the shares have fallen 20% this year, largely down to another business it owns called Mead Johnson, which makes baby formula. Reckitt bought it back in 2017, and it's now caught up in hundreds of legal cases in America. Until that's resolved, it's a difficult one to evaluate. Growth is the other issue. Revenue hasn't really gone anywhere for 3 years. And it's actually slightly lower now than it was in 2023. So you've got a good yield, a payout ratio with plenty of room behind it, a dividend that went up last year, and a valuation that looks cheap next to its peers. What I'm less sure about is the long-term growth and how those legal cases play out. So for those reasons, Reckitt goes into B tier. Aviva is the biggest insurer in the country, and from its results back in March, operating profits were up over 70%. Revenue jumped more than 40% after they bought Direct Line, and the dividend went up 10%. It yields 5.71%, one of the best here, and higher interest rates help them as well, because it makes the pension and annuity side more profitable. You will see a payout ratio of 118%. It earned 27p a share last year and paid out closer to 40p. With insurers though, don't read into this too much. They take your premiums and invest the money, often for decades. Accounting rules make them value those investments at whatever they're worth on the day. So when markets move, the profit figure moves with them, even if nothing has actually changed in the business. The market is certainly expecting it to correct. Aviva has a trailing PE of 26 based on last year's profits, but look at the forward PE, which uses what analysts think they'll earn next year, and it drops to 11. So the market is expecting profits to roughly double, and that would put the dividend comfortably back inside what the business earns. That's an expectation though, not something guaranteed, and it's the only thing keeping it out of the top spot for me. So Aviva goes into A tier. So that's the completed tier list. It's all of course just my opinion, so feel free to let me know if you agree or disagree in the comments. A few of these companies are due to report their earnings soon, so just keep an eye out for that. Also let me know if you own any of these and if there's any you want me to look at next. YouTube reckons you'll find this video helpful next. Thanks for watching.